All right, we have audio now, so I'm going to start over.
Yeah.
My name is Troy Diaz. I'm the lead lender relations specialist for the Small Business Administration Metro New York District Office. It's fantastic to be with all of you today and everyone watching at home or wherever you may be. I'm delighted to be here. I want to thank the Stony Brook SBDC for inviting me. I want to thank my partner in crime here, Arthur Conte, who you'll be hearing from later, who'll be doing a fantastic presentation following the one I'm about to give. And we do have a lot to get to, so I'm going to keep it moving. I've shared the presentation with the SBDC, so if anyone at home would like a copy, please reach out to them. By all means, you can have a copy of that. There's going to be some slides that I'm just going to move through rather fast because the meat of what I want to talk about is really within our capital programs. So just to get started, to give you an idea of what we're going to cover, I always like to talk about our district, who we are and what we do, who we serve. The reason for that is because a lot of people really don't understand what the SBA is, what's available to them. So we'll give a quick couple of moments on that. I also want to talk about lending numbers here on Long Island, where we are today. And it's really a testament to the power of the SBA and our partner lenders on their dedication and commitment to serving small business. So you'll see exactly how those dollars are deployed and the impact they're having. We're then going to talk about what I call the four C's of the SBA: counseling, capital, contracting, and crisis. We're going to spend most of our time on capital. The other ones I'm just going to give a quick overview of. Then we're going to talk about a few key programs of our capital access, which we're going to cover: microloans, our 7A, and then our 504. All three are our most widely used programs for businesses of varying degrees. And then we're going to talk about how the 7A program can be leveraged for business acquisition. It's probably our most used use for 7A loans. Okay. So if you're in the process of looking to buy a business, or if you've never thought about it, I want you to keep what you're going to learn today in your back pocket, because the 7A program is a tremendous, tremendous vehicle to acquiring a business. And then I'm going to hand it off to my friend Arthur Conte. So the New York District, Metro New York District Office, we are the largest in the nation. Our territory is pretty expansive. We cover the lower Hudson Valley, we cover the five boroughs, and all of Nassau and Suffolk County to the tip of Orient Point to the tip of Montauk Point. Within that district, we serve over 1.6 million businesses, employing over 5 million people. So there's a lot that's going on here in New York. Our SBA-backed loans pretty much exceed $1 billion annually, and that's a billion with a B. That's a lot of money that's deployed within our district. And we have upwards of 128 approved SBA lenders that are charged with getting these funds out to you. So we provide a lot of resources, many of which a lot of you are already aware of. You're here with the SBDC, which is one of our technical resource partners. So there's a lot that's available to you. On Long Island, I'm just going to look in the rearview mirror a little bit for fiscal year 25. We did a lot of SBA-backed lending here, over $460 million in Nassau and Suffolk. That was 28% of our overall volume for the district as a whole. So if anyone ever comes to you and says the SBA is not lending on Long Island, just remember this slide, because we are in fact lending, and lending in a great way. What I get most excited about is the volume. It's not really the dollar amount. As a former banker, we always get excited about the dollar amounts, but the small volume loans and the volume that gets out, that's really where the impact is felt. A $50,000 loan is going to go a long way for a small business owner to get them to that next level. So very proud that we had over 1,000 loans go out to Long Island. So let's get into the four C's: counseling, capital, contract, and crisis. Counseling, we have a vast resource partner network. Our SBDCs, as you all know, are a tremendous resource. If you're at home, if this is the first time that you're taking advantage of an event hosted by the SBDC, I would say don't make it your last. Certainly get involved. There's a lot of help available to you. You don't have to go it alone. One of the things about running a business is that it could be very isolating at times, even if you have partners, right? So getting the help that you need is crucial, and it's available to you through our resource partner network. Some of the services available, many of you probably already aware of that. Business plan development, which is huge, one-on-one business counseling and mentoring, financial packaging and lending assistance. If you're going to be applying for capital, don't go it alone. The folks at the SBDC have a lot of experience, a lot of collective years of experience, and they can save you a lot of time in the process. Time is critical. When you're applying for financing, one of the things that folks always say is, how long is it going to take me to get this money? Well, a lot of it depends on you and how quickly you're going to get this package together. But more importantly, you have to know which lender to approach, right? So the SBDC can really help you and guide you in the right direction and save a lot of time and money to that end. On the contracting side, the federal government is the largest single purchaser of goods and services in the world. We reserve at least 23% of all prime government contracting dollars each year to small businesses. So there's a significant piece of that pie available to you. I will say if you have a product or service that will lend itself to the federal government, then certainly talk to the SBDC about getting certified to get into federal contracting. We have our 8A business development program, which is really geared towards new firms coming in to do a lot of hand-holding to get you to the point where you can eventually, quote unquote, graduate and go out on your own. We certainly support hub zones, women-owned small business programs, and we certainly do a lot for our men and women in uniform, our veterans. We have a lot of programs and benefits available to them as a way to thank them for their service to our country. Again, who can help you with this? Your SBDC. And I'm not getting paid to say this by the folks here today, but as a former advisor with an SBDC, I can tell you that the work that they do here is just bar none. It's fantastic. So certainly avail yourself. There's a lot they can do to help you navigate these often complex waters of contracting. And again, just be with you along that journey so you're not alone. Our next C is crisis, and this is the one I think everyone would agree that we wish we didn't have to have. So what is a crisis? A crisis is a federally declared disaster. Think about Hurricane Sandy. Think about what most people, their first foray into SBA was during the COVID pandemic. Through the loans that the government put out, whether it was Paycheck Protection or the EIDL. So our disaster loans are not only available to small businesses, they're also available to homeowners and renters. A lot of people don't realize that. So if you're involved in a declared disaster in your area and there's a loss and your insurance doesn't cover that full loss, then you can come to the SBA for a loan that can help get you to the finish line and bridge that gap. These loans can cover everything from real estate damage, personal property, economic injury to your business. If your business was shuttered due to that disaster and you're not getting revenue in, these loans can help with that. Machinery and equipment, if you have to replace that, inventory, and for our active duty military, if they're out on deployment and they can't run their business, they can also qualify for a loan to help them while their business is shuttered while they're on active duty serving our country. Physical damage loans. So what does that mean? Covers repairs and replacement of physical assets damaged in a declared disaster. Okay. Mitigation assistance. This takes it a step beyond the actual help that you're going to get. So the example I use is if you're located in a flood zone and you had damage, you can use these loans to help with that damage, but you can also use the funds or request additional funds to help mitigate a future occurrence. So if you had to elevate that property, for example, if you had to, put in anything that would help prevent another incident of that same magnitude, you can get funding for that. Economic injury we spoke about. Again, if your business is shuttered, you can get assistance that way, and the military reservist loan to help when they're on deployment. So keep that in mind. Again, hopefully no one ever needs to utilize these loans, but it's good to know that they're there and they're available. My SBA loan portal, this is where you would manage that disaster loan, and not only that, but all of your SBA loans. So keep that in mind too. Lending.sba.gov is where you would go. You create your own portfolio there, and you could manage and see your loans in one spot. If you're used to online banking, you'll be used to how this works. So now let's get into capital. This is really what the SBA is known for most. It's our ability to help businesses start, grow, or expand. Okay. Um, the benefits of the SBA loans as opposed to conventional or traditional lending, which basically just means if you're going to a regular bank, let's use Chase, M&T, if they're going to do a traditional or conventional loan, they have certain underwriting criteria that they're going to look for. Well, the SBA softens some of that to a degree that you need when your bank is not willing to do so. Okay. So we have very startup friendly options. We go out with longer uh, maturities. We also have lower down payments. Okay. Now, what does that mean? Well, when you're going for business financing, it's very rare that you can get 100% financing. You have to have some skin in the game, which we're going to talk about in a little while. And with our guarantee that we provide to lenders, it really affords them with a lower risk. Okay. So we'll talk a little bit about what guarantees are and how they work. How do you find an SBA lender? Well, the first thing that I would recommend is that you start where you presently bank. Okay. Uh, you want someone who understands you, understands your business. You want to develop a relationship. It's very important. So we do have a lot of local and regional lenders that are in our program that are some of them, most of them are preferred lenders, meaning they can move pretty quickly with these loan decisions. But if that's not something you're willing to do, we have something called Lender Match on the SBA.gov website. So what that is it allows you to put in some basic information about you and your business, and it's going to pair you up with lenders who have a high propensity to want to not only work with your industry specifically, but may have a high interest in doing that loan for you. And I mention industry because not all lenders are the same. All right. Now, what do I mean by that? Well, they all have a certain sandbox, if you will, that they like to play in. Some lenders will love to do hospitality loans. If you own a restaurant, they understand that industry. They'll do those loans all day, where other lenders do not want to touch it. So going back to working with an SBDC, I would highly recommend that you do that because they have their pulse on which lenders like certain industries, and that can save you a ton of time. All right. Time is very precious to a business owner. So definitely work with them on that. Um, so what I want to also talk about today is to give you a glimpse into the language of lending. If you own a business, if you're a plumber, if you're an attorney, if you're an electrician, you have your own language, right? There's jargon, there's words and terminology that you use that if you're speaking to another plumber, another attorney, you could have a conversation fluently that I might not understand. The same applies to lenders. They have their own language. So I want to give you some ammunition today to really understand what that language is to a degree, what they look for, so you can be more prepared when you're in front of a lender and asking for funding from them. So what do they look for? Well, they look for a business owner who knows the business. All right. You have to really have an idea of what you're doing. They want to see that you can run it well and that you have a desire to make it succeed. They want to see a business that is financially sound. Okay. If it is a brand new business, that does not knock you out of the box. But you have to have a compelling story to show that you have the ability to generate enough revenue to support the funds that you're seeking. And that's going to come by way of a business plan and projections. Collateral is huge. Okay. Banks are what we refer to as cash flow and collateral lenders. Now, what does that mean? Well, it means you have to be generating enough revenue or cash flow to support the debt you're seeking, and you have to provide them with a second way out or collateral. Okay. So, God forbid the loan should default, they have something to hang their hat on. Okay. And we'll talk about the SBA's role in that, on how we get them comfortable with making these loans when there is a collateral shortfall. And then finally, equity injection. You have to have skin in the game, as they say. Okay. There are very limited exceptions where lenders will do 100% financing. We'll talk a little bit about one of those later, but you have to be able to bring some money to the table. And the SBA requires minimum 10%, sometimes 5. Okay. So keep these things in mind. Has anyone heard of the 5 C's of credit? I can't see you at home, or maybe you can do a thumbs up. But the 5 C's of credit are very important to lenders, and I want to give you an overview of what those are. They are character, capacity, cash flow, collateral, capital, and conditions. This is really, we're now getting into the language of lending. And the reason for this is because lending is all about mitigating risk, right? I tell people, think of it as one of those two-sided scales that you see where, you weigh down one side, the other side goes up. I've yet to find anyone that totally balances out that scale. They have everything that the lenders want. You're going to have strengths in one area and you're going to have weaknesses in the other. Lenders are looking to see how can they mitigate those weaknesses? How can they get comfortable to make the loan? And at the end of the day, they really do want to make those loans. So they do that by assessing the 5 C's of credit. The first one, character, what does that mean? Well, it's your personal reputation. Who are you as a borrower? Who are you as someone that they want to lend to? What's your integrity like? Do you pay your bills on time? They're going to look at your past credit history as a major indicator of that. Do you have past dues? Do you have any bankruptcies? They really want to assess before they even start this process. Are you someone that shows the ability and the care to repay your debts? Next one, and you'll see on the right, this is probably the most important of the 5 C's. This is capacity or cash flow. Does your business make enough money to cover not only the debt you're seeking, but the bills that you currently have? Okay. Want to make sure that you're not stretching yourself too thin. So they are going to examine that very closely. If you do not meet this C, chances are that deal is not going to happen. Okay. If you're a startup, and if you are, just getting out of the gate in business and you're not meeting this, but you have a compelling business plan and projections, that's going to help you overcome this hurdle. Okay. But you have to know your business. You have to be able to speak to that. Some terms you need to know to the language of lending. We have 3 that I want you to keep in mind. First is DSCR, debt service coverage ratio. This is a metric that lenders use to measure your ability to cover your debt payments. Okay. They look for a certain number here to see if you're able to handle what you're looking to get from that lender. A lot of lenders have different DSCR ratio thresholds. The minimum, I would say, you'd be looking at 1.2. At the SBA, we'll take 1.15. Now, what does that mean? What do those numbers mean? Well, think about it. For every dollar of debt that you have, if we use the example of SBA's minimum 1.15, you have to be generating $1.15 for every dollar of debt that you have. Okay, want to make sure that you're comfortable. You have some runway, as we call it. How do they go into that calculation? Well, there's something called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. I promise you, if you go to a lender and you mention this, they're going to get very impressed with you. All right. So these 3 terms, if you have them in your back pocket and you pull them out, they're going to know, hey, this person knows what they're talking about. Okay. You're speaking their language again. This is just a way to really get to the nuts and bolts of what your business is generating. And then debt service, they're going to look as a whole at everything that you have as a business, your current business debt, your credit cards, any loans you have, in addition to what you're asking for. So they're going to look at your total debt service to make sure that it's within the parameters that they're looking for. And again, it's about mitigating that risk, right? So let's show you what just an example of DSCR, debt service coverage calculation. This is EBITDA divided by total debt service. So let's look at on the bottom here, 1.25 is ideal for a lot of lenders. A lot of lenders will look to 1.2, but our minimum again is 1.15. Now I have it highlighted because there's a reason for that. Even though our policy minimum is 1.15, it does not mean that the lender has to abide by that. Okay. SBA loans are facilitated by our partner lenders, which affords them a lot of latitude. Okay. A lot of them are going to run by their own underwriting guidelines. This gives them some additional cushion if they decide that they want to go lower than that. But again, you're going to have to tip that scale in a way that's going to get them to feel comfortable with going to that number. All right. So let's say your net income is 140,000. You're now going to add back those other items, your interest expense, 20,000, your depreciation, 10,000, your amortization. We arrive at 190. Okay. Um, your debt service coverage ratio, when you do this calculation, you're going to be at 1.28 in this example. So is that above a threshold of what the SBA would need and what a lender would need? Yes. So you now qualify for the most important C, cash flow. All right. The next C is collateral. Remember, I mentioned earlier that lenders need a second way out. So what they're going to do is they're going to look at your cash flow and then they're going to look at what can you pledge on this loan. Okay. If you're looking to buy equipment or machinery, you're going to have to pledge that machinery as collateral to the lender in a first lien position. Basically, that means that if something should go south on this loan, they're first in line to go after their collateral. Who is technically first in line if we really want to get serious about it, and that's Uncle Sam, that's the government. The government's always first in line no matter what. So that's part of their risk assessment when they do their underwriting. They're looking to see that everything is in line with your taxes, you don't owe any money, there's no bankruptcies, things of that nature. So collateral is huge. One of the things that the SBA mitigates is when there's a collateral shortfall. All right. We are a cash flow lender. You have to show the ability to repay this loan with your cash flow. But if you have a collateral shortfall, if there's not enough there that the bank is looking for, we will never deny a loan based on that. Okay. Another one of the top reasons that banks come to us and lenders want to do an SBA loan because they know that if there's a collateral shortfall, we will back the loan with our guarantee for them, which is basically like an insurance policy. The next C, skin in the game, capital contribution. What is this? They want to look at your business net worth, what you own minus what your liabilities are. They want to see how much money you have invested in the business. Okay. This shows your commitment to that business. If you're constantly pulling money out and you have no retained earnings, banks aren't going to look at that too favorably. Okay. They want to see that you have a desire to keep this business performing and growing and being healthy. All right. They expect that equity injection, that skin in the game. Again, as I mentioned earlier, 100% financing is not very common. So you have to be able to show that you've got capital to bring towards the project. So if you're looking for a $100,000 loan and financing, rest assured that the minimum that you're going to have to come to the table with is 10%. Okay. Um, so traditional lenders, a lack of equity usually means the loan will be turned down. Conditions, we're almost at the end here. So what does this mean? This means basically how is that loan going to be structured? What's the loan amount? Okay. What's the interest rate? What are you going to use the loan for? Critical. Never, and I mean never go to a lender and just ask for a loan and a dollar figure and not be able to support what you need the money for. Years ago, you might have gotten through that in the early 2000s when banks were handing out home equities like candy and people were coming in. Now, you really have to be able to substantiate. So if you're asking for $100,000, be able to have that conversation on how you're going to deploy it. I'm going to use $20,000 for working capital. I need 40 for equipment, so on and so forth. Part of that language of banking is something they call sources and use. We have to know the sources of the financing and the money that you're seeking, whether it's from the bank in conjunction with your equity, and the uses of that. How are you gonna deploy that? They want to match it up cent for cent, basically. So make sure that you can discuss that at length with your lender. How well is your business doing in your particular industry? And what risks are there? Are you in a business right now that is affected by anything that's going on the global scale, on the global market? If so, lenders are going to look at that. So those are the five C's of credit. Again, part of the language. Is your business a startup? Well, a lot of folks don't understand what lenders define a startup to be. So I wanted to give you a little window into that. First is pre-revenue or pure startup. This is the most difficult to finance for a lender. It presents the most risk on that scale. And why is that? It's because you haven't gotten out of the gate yet. You're not generating any revenue. There's no historical track record. Lenders love to look in the rearview mirror. That's what they do first. And what do I mean by that? When you're going for a loan, they're going to ask for certain documents from you. They're going to ask for tax returns. They're going to look in the rear view and they're going to apply this loan to your prior tax returns to see if your business would have been able to support that loan over the past 2 or 3 years. Okay. So a pure startup is very challenging to finance, but there is hope. And we're gonna get to that with one of our loan programs in just a bit. If you're operating under 2 years, that's generally what banks consider to be a startup. So when you go to a bank and you've been in business for a year and they say, no, but you're a startup, your first inclination is to say, but I've been in business for a year. I have my tax return done. I'm not a startup. To them, you still are. And really, it's because you haven't eclipsed that 2 year threshold yet. Okay. You may not be cash flow positive at that point. You're still getting your sea legs, so to speak. Change of ownership is the final consideration of what a startup is. And reason for that is basically unproven management, lack of operational consistency. If I go and I buy Arthur's business, Arthur's been killing it for however many years. I come in, I could tank that business within a year. So they consider that to be a startup, all right? Which I probably would do, right? Because I'm not an attorney. That's right. I would give it a good go. But so tips for becoming bankable. Again, this may be helpful to you. If you're a startup, at the top of the list, I'll say this too, I'm blue in the face. Work with an SBA resource partner. Work with your SBDC. It's free. It's confidential. A lot of the folks that work in these SBDCs, they have varying degrees of expertise. Take advantage of it. Okay, don't go it alone. Develop an effective business plan. Critical. If you go on Google right now and you type in business plan, you're going to get inundated with results of companies that are going to help you put these plans together. As a former lender myself, and I know Willa will attest to this, anytime we've gotten those plans, they're usually this thick. They're full of graphs and charts and colors and statistics and footnotes and all this. Goes right in the trash. Nobody wants to read it. The most effective business plans that I've seen are 10 pages or less. All right. They get to the point. They talk about the business. They talk about what they need. They provide the projections. They talk about the management, the expertise, why they're going to grow this business. Okay. So please save your money. Work with an SBDC. Let them help you do that business plan. Okay. You're going to need financial projections in concert with that business plan. They can help you with that. Make sure, going back to the five C's, make sure your credit is in good order. If it's not, put some time into that. Make sure you have skin in the game. Minimum 10%. Put some money aside. No lender is going to lend you 100%. Okay. If you're an existing business, a lot of it still applies. Work with your resource partner. Speak with a lender and determine what their requirements are. Okay. Because again, not every lender is going to have a capacity or an interest to lend to restaurants. So don't waste your time there. All right. If you're an existing business, they're going to want to see 3 years of financials. Okay. Ensure you have your personal credits in order. And again, have skin in the game, minimum 10%. All right. Preparation is key. I'm not really going to go into this. We've talked about it a lot. Second one I really want to touch upon, though, you have to know your business and your financial data. Everyone in here has watched Shark Tank. If anyone hasn't, raise your hand. I've yet to meet anyone that hasn't. If you watch Shark Tank, then you know that the one shark that people really get nervous about is who? Mr. Wonderful. Why? Because he drills you on your numbers. And the moment he sees a crack in the foundation and you don't know your numbers, it's over. Lenders can react the same way. They're not as harsh as Mr. Wonderful, but know your numbers, right? Know how to speak to them. If you're not familiar with that language, go to the SBDC. They'll work you through that. They'll go through a tax return and walk you through This is where they're going to start. This is what they're going to look for. Okay. Full disclosure, never hide anything from a lender. They're going to find it. Okay. So if you've had a bankruptcy and you figured, well, it's, they're not going to find it. They are going to find it. Okay. If you have back taxes, they are going to find it. Be upfront. Tell your story up front. That scale again. Some things can be mitigated. Okay. Don't shoot yourself in the foot. All right, let's get into SBA loan programs because this is probably where a lot of you, came from my portion at least. Um, we do a lot of lending, as you know, and one of the biggest misnomers out there is that when you hear the term SBA loan, that we're actually writing the check. And why wouldn't you think that? Because it's called SBA loan. I mean, heck, before I got into banking, I thought the SBA was lending the money too, but that's not how it works. So what happens? The lender is actually making that loan to you from their balance sheet, okay? Where we come in is that we provide a guarantee to reduce the risk on that loan. Okay. Our guarantees run anywhere from 50% up to 90%, depending on the loan program. What does that mean? Well, if the loan should go south and there's a 75% guarantee on it, let's use a $100,000 loan, for example, that business goes under, the loan defaults, the lender comes to the SBA and says, hey, we still have a balance owed on this loan. Whatever that balance is, we will potentially make that lender whole up to that percentage guarantee. All right. So let's say there's $100,000 left that cannot be collected. They had a 75% guarantee. Uncle Sam, the SBA, is going to make them whole $75,000. They're going to take the loss for 25. Now, that does not absolve you as the borrower from repaying that debt. That's going to follow you. Okay. So just keep that in mind. They're going to look at those five C's to assess the merits of that loan, which you've already learned about. So how can our loans help you? In a number of ways. If you're looking to start your business or expand it, that's why people come to the SBA. If you've got a space and you need to do leasehold improvements, you can use an SBA loan for that. If you need working capital, if you're a seasonal business, you can use SBA loans to help you deal with that seasonality. Okay. You can use some of our loans to purchase and renovate a facility. Our 504 loan program is tremendous for that. You're going to learn a little bit about the advantages of that program today. Inventory, equipment, and machinery. If you're looking to export a product or service from the U.S., we have export loan programs that can help you. We have dedicated export managers at the SBA. That's not my expertise, but we have many of them at the SBA that can work with you one-on-one to help you prepare for that. We can't lend to everyone. This is a brief list of industries or business types that we cannot lend to. I usually highlight nonprofits and marijuana third from the bottom. The reason for those is because a lot of people come and say, well, I have a nonprofit, I need a loan. Only in the instances of federally declared disasters will nonprofits be available or qualify to apply for a loan. Marijuana, every state has their own rules. It may be recognized by your respective state, but the federal government still does not recognize that, so we cannot lend to marijuana-related industries. Our eligibility requirements for SBA loans. There are certain things that you need to keep in mind. You must be a small business. We have what's called small business size standards, which we measure either according to the revenue that you're making or how many employees you have. Pretty much safe to say that the majority of businesses that come for an SBA loan, they don't even go near these size standards, okay? You have to be credit worthy and demonstrate your ability to repay the loan. Again, one of those C's, cash flow. Collateral we don't care about. Well, we do, but we're not going to decline it. You have to have a sound business purpose. Everyone that's involved in that business, if you have at least 20%, you have to personally guarantee that loan. We call that PG. You'll hear PG a lot from lenders, personally guarantee. You have to personally guarantee that loan, okay? And the last bullet, 100% direct or indirect owners must be U.S. citizens, U.S. nationals with primary residence in the U.S. That's a fairly new change. It's gone through some iterations over the past year or so, but keep that in mind as well. At the bottom, you have to be for profit, no nonprofits. You have to do business here in the U.S. You can have clients and customers outside of the U.S., but your physical presence must be here. You have to have invested equity. There's just no two ways about that. And the last one on the bottom, you have to had exhausted financing options elsewhere. So basically, what that means is if you're able to get a traditional or conventional loan, then go ahead and do that. It's probably going to be a little less expensive as well. SBA loans carry fees that are associated to keep the program running. They're not exorbitant. They can be rolled into the loan. But again, if you're able to get a conventional financing, we expect you to do so. So let's start talking about the three loans that I mentioned at the top of this presentation. Microloan. I refer to this to everyone I speak to as the sleeper of SBA loans. These loans are fantastic for smaller or startup businesses. If you're just starting out, if there's anything you take away today, remember SBA microloan, okay? These loans go up to $50,000. They can be as little as 500, okay? They're not facilitated by banks. So you can't walk into your local bank and ask for an SBA microloan, okay? These loans are administered by CDFIs, Community Development Financial Institutions. Now, what are they? They are mission-oriented lenders. Okay. The SBA actually loans money to them so they can re-lend it. We lend it to them at extremely low interest rates. They in turn go ahead and then deploy those funds annually at, again, lower rates. And their main focus is to help those smaller businesses that are not bankable, they're not lendable. Okay. So if you're just starting out your business and you need $5,000 for computer equipment or some inventory, a microloan is going to be a fantastic option for you. Okay. These loans go out as far as 7 years. The fees are listed on the screen. 2% for loans 1 year or less, 3% for loans greater than 1 year. These fees can be rolled in so you're not paying anything out of pocket. These micro lenders also provide technical guidance and assistance. They're not just going to give you the loan. They want to make sure that you have an understanding of how you're going to use it. They're another resource for you when you're working with your SBDCs. And the greatest thing about the CDFIs is because they're mission-based and community-based, they have a really good idea of what's going on where they lend. There's a micro lender that serves the Chinatown area in New York City. They really know what's going on. They're tapped into that community, so it gives them a little bit more of an advantage to assess a loan and to decide if they're going to make it. These are our district approved micro lenders. We have six of them, and you'll get a copy of this presentation if you request it. The asterisk just shows you those micro lenders that lend on Long Island. Okay, so if you're here watching from Long Island, those are the micro lenders that you would reach out to. All right. Our 7A program. Many of you may have heard of an SBA 7A loan. Is it an actual loan? Yes. Is it a program? Yes. It's two in the same. It's our flagship program, as we call it. I tell folks, think of 7A as an umbrella under which all these other loans reside. Okay. So we've got our 7A small loans, which go up to 150,000, our standard loans, which go up to 5 million, our express loans that go up to 500,000, which are a great option if you need working capital because they can be structured as term and working capital. And then, of course, we have our microloans. All of these loans come with those guarantees to our lenders. Now, the guarantee percentages really depend on the loan program and the amount that you're seeking. But as you can see on the slide, if you were seeking, a standard 7A loan of, let's say, $250,000, lenders are going to feel a little bit more comfortable about making that loan for you because they've got that 75% guarantee. Okay. Our SBA Express affords a smaller percentage of a guarantee because the lender is really they're afforded a lot more latitude to get that loan done. And the SBA Express loans typically close very quickly. I've seen them close in 36 hours. So there's a trade-off for that. Smaller guarantee, but for quicker expedience to getting that done. If you're exporting, we have programs that can have up to 90% guarantee. All right. What happened to that slide? Well, that's blank. All right. Well, I'm going to talk about it. Well, I'm going to go to the next slide, but I'll talk about 7A. Our 7A loans cap out at 5 million, our standard ones. They can use for a variety of needs, working capital, machinery, equipment, real estate. You can use it for real estate. You do have a better option out there that we're going to get into soon. This slide here, if you're a manufacturing business, okay, we have a lot of benefits for manufacturers. Um, right at the top, we have loan fee waivers. So we have a 0% upfront fee or loan fee waiver for 7A loans up to $950,000. That can save you a significant amount of money. Okay. On our 504 program, we have 0% upfront and guarantee fees for the full amount that we can lend on that. And that can go to 5.5 million. All right. How do you know if you qualify? You're going to look and see what your NAICS code is on your tax return. If you're 31 through 33, congratulations, you fall into these parameters. Okay. These fees are in effect through the end of our fiscal year, which on the federal side ends September 30th. And they do not apply to another loan program called our MARC loan program. Let's talk about our 504 now. If you are a business owner and you're looking to purchase a piece of real estate, this is going to be the program that you want to remember and you want to talk to your lender about. Okay. Very heavily used for buying commercial property. And I'm going to walk you through the reasons why that's so. First of all, the 504 loans provide very long-term fixed rate financing, much more attractive than a conventional lender. That skin in the game portion of it, that equity can be as low as 10%. Okay. On a conventional side, if you're looking to buy a commercial property for your business, real estate is very pricey in our area and everywhere in the country. So being able to acquire a piece of property with 10% down greatly improves your cash flow. Can be used for fixed assets, heavy machinery, so it's not just real estate. There are potential tax incentives. I'm not an accountant. I can't tell you this will apply to you, but generally speaking, a portion of this loan can be exempt from mortgage recording tax. Okay. Uh, these are available through your local lender and also what's called a CDC or Certified Development Company. We have 0% guarantee fees for manufacturers. So if you're a manufacturer, this is going to save you a ton of money. But let's kind of walk through how this loan is structured, because structuring loans is very important. And I tell folks to think about it as a three-legged stool. Let's walk through each of those legs now. First leg is going to be a lender. So that could be M&T, Chase, whoever you bank with. Okay. If we're talking about $1 million loan, 50% of that is going to come from that lender. Okay. $500,000. We have the second leg, which is going to be facilitated by that CDC slash or us SBA. 40% of those funds, that 400,000 is going to come from the CDC. Okay. That's the percentage that's typically exempt from mortgage recording tax for you on that loan, which is significant. The maturity can go out to 25 years. And I skipped the most important one here. If my math was correct, we were at 90%. There's 10 left over. Where is that 10% coming from? It's coming from you, the borrower. That's your down payment. Okay. Your equity could be as high as 20%, depending on the nature of the property and your business tenure. This just gives you examples of that typical structure. At the top is what I just described, the 50-40-10. But what happens if you're a new business or you have a special use property as we classify them? Now, what is a special use property? Well, that could be, are you opening a bowling alley? Are you looking to purchase a car wash? Is it a funeral parlor? These are facilities that really have unique intent and they're special use. They're zoned for those specific reasons. Be very hard to turn that into something else. So again, to mitigate that risk, we just ask that there's a little more skin in the game. That would be a 15% equity injection. If you're a new business and a special use, then we're looking at 20%. Okay. What can you use the 504 program for? You can use it to acquire land if you need to do that and to build upon it. You can expand or renovate your existing building. You can use it for heavy machinery if you need that or fixed assets. Commercial real estate, the caveat here is it has to be 51% owner occupied. Okay. What does that mean? You may look to purchase a building where you're going to only occupy part of it and you have tenants in that building. We require that you occupy at least 51% of that space. You can do whatever you want with the 49%, okay? But the underwriting and the debt service review is going to be based on your operating company solely, okay? They're not going to take into consideration the rent roll that you're going to get from the pizza place that you have in the building or a tenant upstairs. 51%, you're in the game for an SBA 504. And again, another benefit is that these loans can go out as far as 25 years. A lot of conventional lenders, they're going to cap you out at 10 years. Okay. And then you'll have to refinance that portion, which is also a component of a 504 loan because you do have that lender participating as well. One of the best places to start for a 504 is at a CDC. We have three that work in our area. They're on the screen. Again, you'll get copies of this. We have Pursuit Lending, Business Initiative Corporation of New York, and also the Regional Business Assistant Corporation, or RBAC. They're a great option for you to start with because they actually take the lead in this transaction. Even if you're working with your lender, the CDC is actually going to they're going to quarterback that deal. All right. They can give you a synopsis of what you're looking at for that transaction or a hypothetical, which is very helpful for you. It'll outline your closing costs, your fees, what your monthly payment is possibly going to be. Great option to start. And your SBDCs have a great relationship with all three of these CDCs. So we're winding down here. 7A for business acquisitions or changes of ownership. This is one of the most popular uses of our 7A business. And I like to mention it because if you're thinking of starting a business, you may not be aware that a very viable option for you is to look for one that's already up and running. Okay. I have a lot of sellers that are looking to sell. I've read recently, online, they refer to it as the silver tsunami. A lot of business owners are getting ready to retire. They have businesses worth a lot of money. Part of what you're going to hear when I hand it off to Arthur is the reasons why you need to protect that business and things that you need to keep in mind. But as far as using a 7A, it's a great program. Why would you consider purchasing an existing business? Well, it's already up and running. You have turnkey operations. You can basically get into that business and start it right away. They have trained staff, so you're not staffing from the ground up. Lenders love it because you have immediate cash flow. They're going to look in that rearview mirror again and look at the tax returns. This is generating money. You have a lot of things that are favorable for you, which are all listed here. Okay. At the bottom, it's very attractive to lenders for financing. So keep this as an option if you're looking to get into business for yourself. If you're looking for an ownership change, okay, so if you have an existing business, this is one of the ways that 7As are utilized. Okay, you can actually use a 7A for an ownership change in a number of ways. So you have to have 10% equity injection. You're going to have the business plan. This is if I'm going in and I'm buying Willa's business. All right, I'm going to buy it outright. These are the things that the lender and the SBA are going to look for. Okay. Your projections and your supporting assumptions. We talked about debt service coverage ratio. Again, we require 1.15. A lender may want a little bit more than that. All right. We can look at startups, new businesses, changes of ownership in this category. All right. So what's permitted? A complete change, again, or new owners, a partial change, a percentage of a business. This is something that's fairly new. The SBA used to require that if you're looking to buy a business, it was all or nothing. Now I can come in and say, Willa, I'd love to buy 20% of your business. Willa's not ready to retire yet, but this is part of her succession plan, right? She wants to get somebody in the door that is now part owner of the business that has skin in the game. So in 5 years now, when she decides she wants to retire and sell and go off to Florida or wherever it may be, I am more attractive now. I am a prime purchaser and a prime lending candidate to buy her business in full. All right. We have partner buyout, which is a complete change. Some partners decide, hey, I've had enough. The existing partner now wants to buy that business out. All right. So let's talk about complete ownership change. What is this? A person who is not an existing owner is purchasing 100% of a business through an asset purchase. Okay. Small business is purchasing 100% of another business. If you have a competitor that's selling, you can use a 7A for that. All right. The small business and the person or persons must be co-borrowers. You have to PG that loan. Okay. It's not just the business on the hook for it. Okay. How much will the bank or the SBA lend? Well, it depends on how much the business is valued at. Okay. You have to have a valuation of that business. We will never lend more than what that amount is. A lot of sellers really get passionate about their businesses. They have this idea of what their business is worth. If it comes above that valuation amount, you have two choices. Either that seller's going to have to come down through a negotiation, or you have to come up with more of a down payment. Okay. Sellers cannot remain on in that business with a complete ownership change past 12 months. So again, if I'm buying Willa's business, I would love Willa to hang around for 12 months to kind of show me the ropes, introduce me to people. After 12 months, she has to go. Okay. Our loan maturities for this are typically 10 years for a ownership change. If there's a real estate component, if you're buying the building as well, that can stretch to 25 years. So your cash flow is really improved with the 7A loan there. All right. Next is a partial ownership change. What is this? Person purchases a percentage of interest in a business. At least one original owner remains. We just talked about that in the 20% example. So from the buyer's perspective, you have to have a personal guarantee on that loan, regardless of the percentage. If you own a home, you're going to have to pledge that home as collateral. A lot of people ask, do I have to pledge my home for collateral? Yes, you're going to have to do that. We have our own policies of thresholds where we don't require it from the SBA, but lenders often look for that. Okay. You have to have a minimum of 10% equity injection from the seller. 20% or more ownership if you're remaining. You have a full personal guarantee and pledge available real estate for collateral. If the seller is retaining less than 20%, they still have to personally guarantee it, but only for 24 months. Okay. So that's something that the seller is going to be very mindful of to take into consideration how much they're going to look to sell, because they may not want to personally guarantee that loan. Next is a partner buyout. One or more owners buying out the interest of another. Okay, we have three partners. I'm third partner. I decide that I want out. My remaining two want to buy out my stake in the company. You can use a 7A for that. Okay. The business and the owners have to be co-borrowers. There are some underwriting thresholds, okay, that have to be kept in mind. If the 7A loan will finance 90% of the purchase price of the partner buyout, there are certain conditions. I'm not going to go through them here. You'll have this on the slide. Kind of bores people, but it's just for your information to keep an idea of what's required. Sources of injection. We are at the end of my portion, but this is very important. Again, skin in the game. You have to have it, but where is that going to come from? Okay. As a seller can actually help finance that deal. Okay. They can actually help you get to that down payment requirement through what's usually called seller financing or a standby agreement. Okay. At the SBA, we're going to require that standby agreement is on full standby. What does that mean? That means that you have to repay the SBA loan entirely before that owner can start getting repaid the financing that they're laying out to help you buy the business. Is that attractive to a lot of business owners? Probably not. Would you want to hang around for 10 years to wait to start to get paid for your business? Probably not. So quite often, owners look for an all or nothing sale. This is possible if you have a succession plan in place, if you're not going anywhere for 10 years, but you're bringing in someone. So deals are all about how they're structured. We have a lot of latitude for that. for a down payment on the equity injection. If a seller's going to help you, they can help you with that. They can give you up to 5%. So your down payment, your skin in the game is really 5% of capital. Okay. So it's not 10%. Again, all in how you structure it. This has to be cash that is not borrowed. All right. So this cannot come from a personal loan where repayments can be demonstrated from a source other than the cash flow of the business. HELOCs are big on this. A lot of folks want to take money from their HELOC to put into the business. You have to be mindful of that because that's cash that's borrowed. Okay. And grants, if you're able to get a grant for your business, I get asked this all the time. On the federal side, we don't really have grants for businesses. Most of our grants go to places like SBDCs and partners that help folks on a larger scale. The state is different. You may run into grants for small businesses on the state side. As long as they do not have a repayment plan in place for that grant, you can use that money for a down payment. Okay. So we covered a lot here today. I would say if you have any questions, you can always feel free to reach out to me. My number and my email is on this slide deck, and you can reach me through the SBDC. I love helping business owners, but really work with your resource partner, work with the SBDC. Don't go it alone. Again, they're not paying me to say this. I just know from experience, and I've seen the work that they do, and it's priceless, priceless. So with that, I'm going to hand it over to my partner in crime here, Arthur, who's going to talk to you about some things that you need to keep in mind for your business and also personally. A lot of questions that folks may be afraid to ask or afraid to confront. So with that, I'll say thank you, and I tried to get to the next slide, but it's not working. So I'm not really sure what's happening here. But thank you.
Thank you. Good. See if whatever's easier. Share. I emailed Kayla last night at 11 o'clock. That's yeah.
Because of verbal on top,
Yeah.
that is being transcribed.
Okay, so I'm on my screen. I can't really see.
Oh, you
Okay,
can't
so
see that.
yeah, okay. I can see it on this one. Got you.
Ah.
This is the one.
Yeah.
I think the issue with like the formatting is because it went over to like the Google, so maybe some things didn't come over
That's
good.
okay.
Yeah.
Close
Yeah,
enough.
so I think we'll just use this thing here.
Just use the arrows.
Yeah, it's up and down.
Oakley dokley.
Yeah, it takes some.
That's fine. There. Cool. Thank you. Good morning, everybody. My name is Arthur Conte. I am an attorney that practices in the areas of estate planning, elder law, real estate, and with that, I always talk about the fact that when you're a good estate planning attorney, one of the things that we deal with a lot is business owners and individuals that own companies and how that plays into, creating estate plans, managing your estate plans. But, part of what I do for my clients is not just write a will or write a trust, and we'll get into what all that is, but it's also dealing with the formation of those businesses. Do I make an LLC? Do I make a corporation? How do I get taxed? What are the implications of making all of those decisions? So I want to talk today about a couple of things. First, I'm going to talk about the language we use in estate planning and what all these terms mean, because part of what is so important when you start a business or when you're getting into a business or when you acquire a business or sell your business, any of these different stages of business ownership, it's important to make sure that you are considering what happens with those decisions and how it affects you, your family, with your estate planning, tax, decisions and tax ramifications of those decisions. So you're going to get this presentation. I've emailed it so you can get a copy of this presentation. So don't write everything down. This is a little bit about me. I started my own practice in 2018. I then merged with another individual in 2021. It's interesting. I just want to bring this up. So Troy and I met back in 2020 during COVID because at that time, he was helping one of my networking organizations that me and my partner were in, that when we were talking about doing the EIDL program and the PPP program, and we all had questions. We had a group of over 100 people, business owners, professionals that were asking about these programs, and that's how I got in touch with Troy. And I will tell you that the resources from the SBDC are phenomenal, that it helped so many of my colleagues and friends who were in business for 25 years, not people who are just starting out even, but people who were in business for decades who needed help with these kinds of situations when we were going through COVID. So it really is, again, I'm not getting paid for this either. It really is a great organization, and it's a really great resource that you need to look into. So, what are we going to talk about today? So first, I want to give you kind of a very quick overview of what estate planning is and why it's important for any person in this room, any family member you may have, any loved one you may have, but why it is especially going to be important for people who are business owners, and what you have to think about and what you have to consider once you start a business, once you acquire a business or sell your business, all these different scenarios that come up. What do we have to worry about? So, what is estate planning? When a client comes into my office, the first thing I always tell them is, you have an estate plan already. You don't know it. You may not consider yourselves as having an estate plan, but you have one already. If you have a joint bank account with somebody, you own a piece of real estate with somebody, you have a business partner even, you have already created some kind of estate plan, because the question is, well, what happens if I become incapacitated at some point in my life for a medical reason, for age, Alzheimer's, dementia, you get into a coma, God forbid, some medical episode. What happens if that ever happens to me and I can no longer make decisions for myself? What happens to the ownership of my assets and the management of my day-to-day life, including the management of a business? And what happens after I pass away? Who gets my assets? Which includes the shares or the ownership stake you may have in your businesses and your bank accounts and your real estate and all of that. So it is important to understand that what we do as attorneys when we are talking about estate planning is we are using wills and trusts and advanced directives and other tools, and even just changing a beneficiary on a life insurance policy. We are using all of those tools to alter the plan that you may already have by default, to make it what you would want, to make it more protection, give you more protection for your assets and for your family. So understand that, like, what we're doing is altering what's already there. And it helps when you look at it from that framework, it helps you understand why we want to decide to use this tool versus this tool. Part of estate planning also deals with those advanced directives. A power of attorney and a healthcare proxy are the two big ones we always talk about. A power of attorney for a business owner can be very important, because you may, God forbid, again, something happens to you, something happens to a business partner. Who's going to be able to access the business bank account? If you don't list employees or other business owners on the business bank account, you went to the bank and it's just you by yourself and you have nobody else on that bank account. Nobody can write checks. Nobody can access that money and pay the bills and run payroll and do all of those simple things that you think of that you just do every month with your bank account. No one's going to be able to do that. So those documents don't just help people, in general, but they're very important for people who are business owners specifically. The only other thing I always mention is estate planning also involves the decisions of not just who gets what and how they get those assets and what form those distributions or that inheritance or whatnot takes, but it's who do you put in charge? Who's going to be your executors, your trustees, your power of attorney agents? Those are all very critical decisions, and ones that usually takes the most time when you're talking to somebody like me. So quickly, I'm going to go through a couple of things. So we talk about, you hear wills and trusts. What's a last will and testament? What's a trust? So a last will and testament is simple. It's a document that basically states, hey, when I pass away, who's going to get my stuff? How are they going to get it? And who's going to be in charge of making sure that those people get those assets? And who's going to run the business of my estate, so to speak? Who's going to be the executor is always what people think of. What you have to understand, and what's always confusing, is that a will only deals with those assets that pass through your probate estate. Probate is a process, it's a legal court process. Don't believe every myth you hear of how scary, frightening it is. It can take a long time. It can be kind of expensive for some people, but it is not always the worst thing in the world. It's not always the big bad wolf on the block with when it comes to dealing with the court. Sometimes it's very quick and easy. Sometimes it's wrapped up in a matter of 3, 4, 5 months. Sometimes it's a year, but it's hard to predict when that's going to come up. But the will is only going to cover those assets that pass through probate. And those are assets that you individually own. Nobody else is on those assets. There's no beneficiary. There's no joint owner. And a lot of times with business owners, that can be the shares you own in your business if you have a corporation, or the ownership, a membership interest in an LLC if you have an LLC. That ownership stake is very often overlooked as part of someone's estate plan. That's a personal asset. And so that automatically becomes part of your estate. So if you pass away and your family wants to sell your business, they have to wait. And very often, the value of many businesses, people who are attorneys, accountants, financial advisors, anybody in the service industry, electricians, plumbers, anybody who doesn't hold a lot of inventory or equipment, their businesses are going to lose value very quickly when the person that runs the business is the business, so to speak, and they pass away. You're going to lose that. You lose that value very quickly. So making sure that we do something with those shares in those businesses oftentimes is very important to making sure that we don't lose that value. This slide kind of just goes over again what happens with probate. The most important thing to understand is when you have a will and you say, well, I want these people to I want my business partner to get the shares of my business, or I want my cousin or my son or my brother or sister, whomever, I want them to get the business, but my spouse and kids get everything else. That's fine. You could say that, but none of that actually happens until that will goes through the probate process and is submitted to court. And that can take time, and that's going to take money. And so if you're in a situation where you don't think your family or your loved ones are going to be able to do that quickly, that business is going to sit there and could potentially suffer for a long time. Now, people always talk about trusts. What is a trust? So a trust is really two things. It is the document that we sign that creates a legal entity that can own stuff. So it's both the document and the actual legal entity. A trust is kind of like a corporation or an LLC. It is an entity that can own assets. It can own stuff. It can have a bank account. It can own real estate. It can own the shares of stock in corporations or LLCs. And so what a trust's main job is what people use it very often for, is to avoid that probate process. Whatever assets you take and put into this trust, the trustee, whoever you name as trustee of that trust, and or successor trustees, they will be able to manage and use and touch those assets immediately. Whether it's you're creating a trust where you're the trustee and then you pass away and you name a successor trustee, that successor trustee, the day after you pass away, can take over and manage those assets, including the business. And if you want that business to be sold or changed hands and sold to a family member or sold out to a third party, they could do that. And so trusts become a very big portion of what I recommend for business owners. A lot of times, once you have an established business, it is very important to think about this, because you don't want that business to lose value. You don't want the business to be interrupted. You don't want your employees to suffer if you start to hire people. It's very important to think about that. Trusts have a bunch of different players involved. So you'll hear different terms like a grantor or creator or a settlor. This is the person making the trust. Typically, if you're going to somebody like me and you want to make a trust, you're going to be the grantor of the trust. In some types of trust, you may be the trustee. In other types of trust, somebody else may be the trustee. This is the person that's kind of like the CEO. They're managing the trust. They're carrying out decisions and following the instructions of that trust document. And then the beneficiaries are the people who get to benefit from that trust and those assets in the trust. And you could have some beneficiaries while you're alive and a different set of beneficiaries when you pass away. Typically, people say, hey, I can enjoy, or my children can enjoy the assets of my trust while I'm alive. And then after I pass away, the trust is just going to give them, my children or my family, whoever is going to give them those assets out of my trust. It's a little graphic, just to kind of give you the idea that the grantor is kind of like a shareholder in a business. They kind of have the skin in the game. They own that stock, but they don't own the assets that are inside of the trust anymore. The trust owns those assets. So the real estate, the bank account, the investments, whatever it may be, the trust is the actual owner. The person who made the trust, once they put those assets into that trust, no longer owns it. And the trustee doesn't own it either. The trustee is just carrying out the terms of that trust. Kind of going to go over this quickly, but there are two different types of trusts. You can break down trusts into several categories. You can break down trusts into when a trust is created, whether it's a testamentary trust, which is a trust usually you create in a will after you pass away. You're saying, hey, my 12-year-old kid isn't going to get an inheritance outright. They're going to get their inheritance in some kind of trust, and the terms are in your will. We call that a testamentary trust. Most of the time when we talk about a will, a trust, we're talking about what's called a lifetime trust or an inter vivos trust. That is the trust where you go to an attorney, you sign a trust document today, you're creating that entity today. And so when we talk about lifetime trusts, there are revocable trusts and irrevocable trusts. Revocable trusts are simple. They are trusts that you create. You're the trustee, you're the creator. It's all the assets are there for you. You're in charge. You can amend the trust. You can get rid of the trust. You can do whatever you want with the trust. It's yours. There's no tax implications, nothing like that. And so the only thing a revocable trust does is it avoids that probate process, like we talked about. On the flip side, an irrevocable trust is one where you typically can't revoke and amend that trust document. Somebody else is going to be the trustee. So you're putting your trust in somebody else to actually manage the trust properly and do the right thing. And you're giving them instructions who they can give money to, who they can't give money to, what they're supposed to do with the assets while you're alive. And then typically after you pass away, they're going to be distributed to somebody. And so irrevocable trusts do a lot more than just avoid probate. They do avoid that probate process, but since you're giving up some semblance of control, what's the benefit? The benefit is that depending on how you structure it, how irrevocable you make it, and there's a spectrum of that, you can get some tax implications and protections. You can get some asset protection and creditor protection and divorce protection and Medicaid planning protections for older seniors where they're worried about a nursing home or something. There's a million different reasons why you would do an irrevocable trust, and there's a million different types of irrevocable trusts that exist. So that's more of an individualized goal. And sometimes we'll make multiple irrevocable trusts for people if they have a complex enough situation. But for you, just now, for this purpose and as a business owner, you can understand that an irrevocable trust, you're giving up some of that control, but you're getting some protection in return when you place those assets into the trust, whether it's your house, whether it's the shares of your business. And you could still operate your business sort of as the CEO and as the president of your business, but you will no longer be the owner of the shares, the owner of that membership interest of the LLC. And then we talked about before advanced directives. These are documents that really apply mostly and almost exclusively to what happens if I lose my capacity. Here are the decisions I would want to make. Who's going to handle my finances? Who's going to handle my medical decisions? What medical decisions do I want? Who's going to handle even down to my funeral arrangements and where my body goes and where is it buried and all of those decisions. And you could even pre-plan your funeral. I mean, it gets really nitty-gritty with some of the things that we can do. For you, the most important document, one of the two, is going to be a power of attorney. Understanding like, hey, this person can go and help operate my business if I lose my capacity is a hugely important document. Sometimes I will tell people a power of attorney and a healthcare proxy are more important than even having a will. Because if you pass away without a will, there are still people that will inherit your stuff. It may not be who you want, but there's a process. If you are in a situation where you can't legally make your own decisions and you need a power of attorney, and you don't have one, a guardianship we have to start a guardianship process for you. And that's tens of thousands of dollars and months and sometimes years of being involved with the court. Finally, with estate planning, changing the ownership and the beneficiaries on your assets is as much a part of what estate planning is all about as is actually creating that trust, executing that will, signing your advance directives. When you make a trust, it's an empty bucket. You sign a trust document today, it's empty. There's nothing in it. You have to deed your house to the trust. You have to change beneficiaries of your assets to the trust, move your shares of your business into a trust. There's a lot of different things that go into when you do estate planning. That's not just signing documents. This is always often overlooked and an important step. With businesses specifically, when we have clients that have businesses, part of what we always talk about with estate planning specifically is, okay, what happens if you want to sell your business while you're alive? What happens if you become disabled and can no longer participate in your business? What happens if you want to bring on a new business member? To a new owner of the business and you want to bring them on. What process do we have to get involved in? And that's where having like operating agreements and bylaws and something we call buy-sell agreements or partnership agreements, any kinds of types of agreements and processes, that's where these start to come into play and where we will draft these shareholder agreements that say, hey, it's just, me and Troy today, 50-50, but if Troy wants to bring his friend or his brother on, I have to approve it. And what are we going to what does that person have to bring some money to the table to invest as a capital contribution or not? Or are they going to come in with sweat equity? These are all things that you may not think about, but it's important to understand. Or what if I have a partner in my business. We have a buy-sell agreement that says, well, if I become disabled or he becomes disabled after a certain period of time, if it's a permanent disability, what happens to my ownership stake? He has the right to buy me out. And I'm agreeing to that in advance and saying, okay, if after 2 or 3 years my disability is permanent, you can get some funding, you can get an SBA loan, you can do a lot of different things, and you could start to pay off my trust, my estate, my family, and get the shares out of my name and back into to his name essentially in exchange for buying me out. And what are the terms of that buyout going to look like? What's the timeline? How do we value the business? All things that we talk about when we try to get lending is what lenders are going to look at. Oftentimes we're looking at that internally for ourselves too. Do we say that the value of a business is 3 years of our gross revenue for the last 3 years? That's a typical one that some businesses use in some industries. So that's where my job as an estate planning attorney is not just, hey, let's create these documents that say what happens when you pass away. It's, well, if you're a business owner, how do we tie all of that together? How do we make sure that when we acquire a business, when we start a new business, when we're ready to retire, that we have all of these documents in place that nobody has to think too hard. We just read, oh, we created that contingency, which we're really protected. One of the other things that we do and considerations that everybody in this room and everybody who has family members should really think about is when you do estate planning, there are asset protection reasons we do estate planning. There's a lot of times for 99% of us that aren't worth, $10 million, we're thinking about Medicaid and what happens if we get old and get sick and need to go into a nursing home, need long-term care costs paid for. That's where Medicaid benefits can come in. And part of what we do as planning attorneys is to get you eligible for those benefits. So there's a lot of different implications with any type of estate planning decision. Any estate planning decision also can affect your taxes. Now, again, most of the time for most people, again, unless you're worth $10 million, you're looking at not really fundamentally changing the tax implications of starting a business, transferring the ownership of a business into a trust. Nothing is going to fundamentally change with your income taxes and anything like that. For those who have higher net worth, yes, we're going to make decisions that maybe have to change the way you may pay estate taxes if you pass away. But for the most of us, we're worried about income taxes and capital gains taxes. That's 99% of us are what we're worried about. And so what we do will always take into account what decisions those are going to be. If you sell your business, you purchase another business, what kind of sales tax are we going to have to look at? What kind of, what is the valuation of those shares? And did we pay the proper valuation? And is the IRS going to turn around and say, you bought a $10 million business for $1 million? No, you have to pay more in taxes on that. You BS'd your way through that. And so there are very important decisions that people often overlook and say, I buy this for $1. It's fine. It's on paper. It's $1. There's an episode of Yellowstone that I don't know if you guys have ever watched the show Yellowstone, where they talk about selling the ranch for like $1 for the land. And it's like, no, like you can't do that. Like that's all BS. The IRS is going to see right through that. The state tax department's going to see right through that and go, yeah, it's a legitimate sale, but it's a gift. You've made 99% of the value of that land a gift, and that there's going to be subject to different tax ramifications for doing that and asset protection ramifications. So it's very important to make sure that talk to an attorney, because a lot of these things that you see in pop culture, it's not true. Okay. Now, when we talk about forming your business, buying a business, selling a business, acquiring, merging your business, what are the things that you should be thinking about? And so, first of all, you're starting a new business. You have a business that you've been running for a while. I know people that have never even thought about starting a corporation or an LLC. Number one, I think you should always do that. It's more often than not, it's going to be an LLC, but there are certain times where doing a corporation is a little bit better of a decision. And that's a conversation for your industry. That's an industry and tax specific discussion. But you should always make sure that you're setting up a business entity. Employee you have does something wrong. You're getting sued by somebody. The assets, your personal assets, are protected if you're running your business as an LLC or corporation. Only the company's actual assets, money in the company bank account, assets owned by the business, whether it's equipment, cars, a building even owned by a business, that is going to be the only assets over which that person can come after for that lawsuit. So you don't want your own personal house and your 401k and your savings account to be exposed, and your spouses in some cases as well. You don't want to do that. So making a business is priority number one. And then setting up those books when you get people or go to their accountant very often and form an LLC. And then you get this binder very often from a lot of companies that make these, and they leave the operating agreement blank, and they get a binder and they don't touch it. One of the things that we do is make sure that those books are at least set up with the basics. You have a basic operating agreement. You have a banking resolution. You have, you got an EIN number properly from the IRS for the business that you decided, am I going to be an S corporation or a C corporation? And, or am I going to have an LLC as a single member LLC? What's the difference? Why does it matter? Ultimately, these decisions matter. These are mostly tax decisions. When you see influencers on Instagram and TikTok talk about, oh, you got to have an S corp. Maybe it's important to have an S corp, but not for everybody. There comes a point where it doesn't pay to be an S corporation anymore, or you can't be an S corporation because you have non-individual owners of a business. And guess what? Can't have an S corp if you have shareholders that are not people, not human beings. Another company is your subsidiary, like as a subsidiary. Can't do that anymore. It's also important to hire the right advisors. More important than me is a good accountant and a good bookkeeper, because you need to make sure that when you start running a business and you're paying bills out and writing checks and swiping that credit card every day for something, and you're, making distributions and you're paying yourself, that those are all booked and categorized properly, not just if you ever get audited, but then when you do your taxes at the end of the year, when you have to file, payroll taxes and all, that's all done properly. If it was me, I would tell you, when I first started my own business, I hired an accountant and I started using QuickBooks. And yeah, I used like the cheapest QuickBooks version, and I had the as free or $10 a month version. Why? Because at the end of the day, I didn't want to screw it up and make a mistake and on a business that wasn't making a lot of money still get audited. And so hire that accountant, hire that bookkeeper. Even if, after the point at which you can't do it yourself anymore because you're running that business, that's when you have to hire those professionals and make sure you're not making mistakes. Because we talk about sometimes, I just was talking about this last night with a client. They have a nonprofit. They had a grant from Suffolk County as a nonprofit, and because their books incorrectly categorized administrative expenses as administrative expenses and not something else, their administrative expenses were over 20% of their total revenue for a year. Okay, who cares? Suffolk County cares. When Suffolk County and Nassau County and a lot of municipalities give grants to nonprofits, guess what? you can't have more than 20% of your costs be administrative expenses. Well, they miscategorized 2 years ago, and the county said, well, you don't get any more money now until you prove that you fixed that. So that $7,000 they were getting, which was meant to do a job for, for a school district that they work with as a nonprofit, they can't do that now in September and October because they don't have that 7 grand, and the school district, nobody else can come up with it. So you got to be careful. Like, these are decisions that you don't, it's no big deal. It can bite you big time. So always hiring a good CPA, a good accountant, good bookkeeper, making sure that everything is filed correctly and on time. And investments, sometimes hiring a good financial advisor will also help you make the right decisions, both personally and with your business in how do I invest my money? What am I going to spend what am I going to budget for next year? Just not having a business plan written down, which you should have, but what am I budgeting? Okay, I made $100,000 a year in revenue in 2025. I'm projecting to make 125,000 in 2026. What am I spending that money on? What did I spend it on last year? What am I going to expect to now have to spend next year? Increasing in costs, increasing in this. Hopefully we decrease, some expenses here. I don't have to hire an independent contractor. I have an employee, whatever. I mean, whatever it is. Those are things that you need to work with a professional on, because they're going to help you make those decisions and do things that are realistic. You can't make 100,000 in year one and say, I'm going to make 500,000 next year and not have any tangible reason why you think that. If you do, great. If you have contracts, you have, you're going to make them, fine. But now what do you do with that money? These are all very difficult decisions that you have to make sure that you hire an attorney for, because there are contracts, there are sales tax, there are, different kinds of decisions that go in. Who's going to assume debt, who's going to take care of things. If you're going to buy a new business, I had a client that was purchasing an auto body shop, and he worked for an auto body shop and was buying another one. There's a ton of paperwork that goes into buying that business. And a lot of it had to do with the prior business owner had debt. He had contracts, he had loans, and the new business owner had to personally guarantee all of those new loans and had to assume and create a new entity, like a new LLC, and take on and those lenders had to be notified. And it's a lot. There's a lot to it that if you don't cover all of it, you're going to make your life a lot harder at the end of the day, and maybe have a debt that gets accelerated and have to pay penalties and interest on that you shouldn't have had to do. So my biggest thing is that when you think about doing this, if this is your foray into a business, is buying into a business, or you have one and you're like, I'm going to merge with somebody, I'm going to acquire them, I'm going to sell. Before you even get to that point and having that conversation, talk to an attorney, make sure your books are up to date, make sure you've had every shareholders meeting on paper, that you've had every major decision was papered with a signature by the owners of a business, that, these are all done, that your taxes and your books are all up to date. You don't, owe back taxes for 4 years. You're not selling a business if you are behind 3 or 4 years on your taxes. It's not happening. So these are the due diligence things that you may hear. Due diligence. These are due diligence items that you should take care of before you ever get into any of these major business decision-making processes. And we help making sure that as an attorney, we're representing you and we're cleaning things up. And then we're talking to your buyer or your seller that's on the other side, that you're not getting screwed. So, oh, sorry, wrong direction. So at the end of the day, should I merge? Should I become an affiliate? Depends on your industry. It depends on your situation. Depends on what makes sense for you. Come talk to us. It may be a good idea. It may not be a good idea. It really depends on your personal finances, your type of business, where you're going, your relationships, your network, all things that are really important. So if you have any questions, this is my contact information. You will, in your folders for the people that are here, there's also a one-page summary of all of the things we do. There's a QR code on there for our website. For those on Zoom, you could take down this information. You will get it as well. But if you guys have any questions, I guess, me and Troy will be here. Thank you for listening to me drone on for a while. And I hope this was helpful. Thank you. Yeah, I know. I'm making big soon.
Really, really great stuff. Thank you very much. Is there anything in the chat? No question. No question.
No,
Oh, yeah.
So
Wait.
when you're talking about acquisition of a business and somebody's buying a business.
Yeah.
So
Hey, everybody, we got some questions here, so yeah, I'm just gonna turn this around. Let me know if you guys can hear.
I'll stand near there.
Yeah.
somebody's buying a business and they're not buying the good faith, anything like that. They're just buying maybe the inventory, the actual space, but they're not buying like the good faith business with customers. It was always my assumption that they didn't also assume the debt because they're not buying the business. Is that a way to protect a buyer?
It can be, yes.
Okay.
Yeah, there's a million different ways to buy into a business, not just as a minority interest or a shareholder. There are ways you can buy into a business over time, but yeah, there's also, I want to buy your equipment. I have a client now, she's 87, God bless this woman. She runs a party rental equipment company where you have a party, you rent out couches and tables and decorations and all this stuff. She's been running it for like 40 years. And she's finally getting ready to retire. And they are not selling the business as a whole. They've gone back and forth 10 times. And they said, we're just going to sell each individual piece of equipment to this one buyer. And that's it. And then they're separately going to buy the building that they own. Just a fun fact: if you have a building for your business, 99 times out of 100, the business
That's right.
entity is not going to own
Right.
the building,
In a trust or what?
or it's going to be in a separate LLC.
Yeah.
Very often.
Yeah.
Very often. I mean, we're in the middle of the process of looking for a building, my law firm, and I talked to Troy, 6 months ago. And he put me in touch with Rob Root at Pursuit.
No, we can help you too.
Right. So we've been told, right, but we're in the process of looking for a building. So we're doing all of the same due diligence too with that.
Sure,
And
you
like-
put the building in a holding company.
Right, and that's going to the holding company.
Yeah.
That's the standard practice of what you do for mostly for tax and asset protection reasons. But yeah, I mean, you can purchase businesses by doing a lot of different things and getting creative, and that's a much cheaper way to do it. But the seller may not want to do that depending on if they want to actually truly retire and they have a $200,000 per business loan on the line of the line of credit on the business. Well, they got to take care of that before
Yeah.
they sell the business off to you. So you have to make sure you're careful with that. They may want to throw that in at the 11th hour, and you go, wait, whoa. Because when we do our due diligence at looking at purchases and sales, we're like, give us your tax returns, give us your books. And you have to go through and say, what is this payment for? Oh, it's a loan payment. We need that loan we need that note. Show it. Like that's where having somebody like us comes into play, where you're not going to be blindsided by things like that at the 11th hour at the closing table, so to speak.
Thank you.
Yeah. Sure.
I've got a question for you.
Uh-oh.
Well, really, it's it's just an observation on a lot of what you talked about today. Is it safe to say a lot of folks, what they think about it when they experience it. At that point, it's too late.
Right.
So the planning is so critical. And the last time we presented together, I remember we met a gentleman afterwards that just broke my heart. He shared that his father had a business.
Yeah.
His father passed away.
He called me.
Didn't
Just
have,
so you know, yeah.
great.
And
Didn't
like,
have
yeah.
anything in place, and both he and his mother were now
Rambling.
they are just in such a crisis situation. They can't access anything. Bills aren't getting paid.
Yeah.
So even if you're a solo owner, if you've got a family, if something happens to you, that business is now untouchable because you didn't plan.
Right. Like
But you don't see that until it happens to
Until it's
somebody.
too late.
You realize how devastating it is.
9 out of 10 people that walk into my office and make an appointment are coming because they just got burned, or a family member got burned, or their neighbor got burned, or somebody they work with got burned by the probate process. This kind of situation. Grandma went into a nursing home and she had to pay $18,000 a month for a nursing home. Who the heck has that kind of money? These are unfortunately the situations that most people don't think about, aren't educated about, and it's not anyone's fault that they're not educated. It's because the system is so complicated. And one person is not meant to know all of these things, unfortunately. And so if nothing else, what we try to do, and I mean this genuinely, like as what my firm tries to do and what me and my partners try to do is we're here to educate. We're here to sit down. We don't charge for a consultation because we want people not to be afraid to come sit down or have a Zoom meeting with us and talk to us about their situations and go through it and say, hey, here's an education, by the way, the 3 things you probably aren't thinking about, because who the heck knows these things unless you've been through it before. And so that's why at the end of the day, everybody should, especially when you're getting into the idea of owning a business. That's not just a big step from I am owning a business, I'm not working for somebody anymore, or I have a passion. It's how is this going to affect the rest of my life, my family, and my loved ones, financially, taxes, asset protection, people getting old. Like there's 1,000 different things you can't think of. And that's my job, is to try my best to think of all of those things that you don't think about, because I see the worst of it daily. So yeah,
So
plan before something bad happens. Yes.
I have a question still. But does it matter the structure of the business? If you were a sole proprietor, would it be the same? You can't touch the business after the business dead? Or is it because it was an LLC or an S corp? Which one is easier to sort of?
So technically, from a legal standpoint, when you start a business as a sole proprietor, you don't have to create an LLC or a corporation, but you should. Because, and here's why, here's the reality of what happens. You're a sole proprietor, you can register with the county to act as a DBA, and you make your own business name and you get a tax ID number, and away you go. Now, that's all well and good, but if something happens from a liability standpoint, or you try to get certain types of insurance, you just make your life a little bit harder. Filing taxes and getting certain tax deductions, it gets a little bit harder. So yeah, in the very, very beginning, sure. But very early on in the process, creating an LLC makes it obvious that you have a separate legal entity or a corporation that is separate from you as an individual. And remember what Troy said too about the 2 years when it comes to getting lending and being a startup or not being a startup. When I started my law firm in 2018, that's when I went on my own. My wife and I went to buy a house in 2020, right in the middle of the summer. I was literally months away, but still away from being 2 years in business. And I could not be on the mortgage application for my own house because I wasn't in business 2 years. Now, thankfully, my wife had a job and she was full time and she made enough money where we were able to get the mortgage without me being on that application. So, but what would have helped? Well, if I started my own business in 2017, but I waited to 2018, well, I could have saved myself, and maybe we've gotten a better interest rate and whatever. So things like that happen where if you wait to do those correct decisions, the system is going to screw you in some way like that, even if you don't think about it. And so it is best to be prepared. Then the other problem is if you ever do get sued, you do something, you ever have a workers' compensation claim, anything like that, having a business entity makes you be able to put your head on the pillow at night. Because now there's no question. I'm running this business as a legitimate separate entity. They're only coming after the business. They're not coming after me personally. They'll try to sue you, but you kick yourself off the lawsuit because you have a business. So it's more about that kind of protection too.
But in terms of estate plan,
Yes.
if you're a sole proprietor and you pass away, can your family have easy access because
No.
you're not right?
No. So if you pass away, if I put the shares of your corp or the membership interest of your LLC into your trust and it's documented properly, you walk into the bank with a death certificate and say, well, my mom, she ran this business, she passed away. I'm the successor trustee on this trust, which owned the shares of this business. The bank will review it for 3 days and go, okay, you now have access to that bank account for that business. You run a sole proprietorship with a DBA at any bank, they're going to go, death certificate, I don't care, go open her estate. And that can take months and months and months. And goodbye to paying your bills for the business, goodbye to paying payroll. It's a nightmare. Taxes, you have to pay quarterly taxes. Another thing with business owners, a lot of times you don't think about is many times if you have, and once you hire employees, there's very often tax filings that have to happen. And like I have a payroll company, so I don't think about this, but I see debits from my payroll account all the time, quarterly. And I'm like, it's not payroll week. Oh, yes, it's quarterly. payroll filing season and they have to adjust my quarterly. These are so many things that you're like, I can't think about this anymore. Even when it's just you and one employee, that takes away from you being able to run your business. And it's just a good business practice is the less you have to administrate your own business and you can pass it off to professionals or companies or CPAs or advisors, the better, because you have more time to invest in your own business and grow your own business. Like I couldn't be here today if I wasn't doing those kinds of things because I'd be sitting there running payroll manually. Can't do that anymore. But I couldn't even do it. I was just by myself. Like, so yeah. Good. That's a really good question.
Thank you.
Yeah.
Yeah, so there's something in the chat there. Michelle
It's not a question. She just said there's office space of a building in Holtzville right next to the ISS.
Michelle, did you have a question? Can you unmute?
You're on mute.
yourself? I see you.
Oh, I'm unmuted. Okay, hi. Thank you so much. I enjoy
Yeah.
hearing
You
everything
have
that
to,
everyone had to say.
Turn up the volume.
Oh, can you hear me?
Yes.
Yes.
Hi. Yeah, thank you. I'm so honored to be here. Thank you. I love everything that you guys offer. I do have definite dilemmas that I'm facing right now in my studio. I have an art studio. I'm actually in it right now. It's like 2,000 square feet. Is a 4-story building. There is a lot of space here. If you're looking for space, they're renting it here. It's really nice. Thank you, sir. But my question is this, that I've been having an issue with, and I'm trying to get my certificate of authority. And I've been running into a dilemma with this for now 10 months. And I thought I had it figured out last week, but it turns out that it's not. It got rejected again. So I understand that when I file for this certificate of authority, it's on an automated system. So that's the problem. There's no one really to physically speak with. So I've been having an issue with it. And I thought it was resolved when we did the roundtable meeting afterwards. I sat with Robert and I thought, we had it fixed. So I did the application all over again and it got rejected. So I'm really not sure what's going on. It's saying that there's a mismatch, that I'm labeled as an LLC, but I'm going for a sole proprietor. But all my EIN number is a sole proprietor. My certificate from the court clerk is also a sole proprietor. So I'm really not sure how to overcome this. And I Uber and Lyft drive in between so I can still pay my rent. And again, I've been here for 10 months. So I'm getting a little scared.
Well, I think
and
there are companies that there are companies that are up in with that you could talk to with that are law firms specifically going to the different county clerks and even up in Albany with certificates of authority and whatnot. It's a pain. And this is like another reason why I almost never recommend like staying as a sole proprietor because companies and banks and institutions and even the IRS prefer that you form an LLC because they get it. They understand it and it's clean, separate, entity. You're filed with the New York State Department of State and it's much easier. So I know you can't just go and flip and do that now, but send me an email. There are companies I can probably put you in touch with to square that away. You might want to check to make sure that your taxes didn't file improperly as like this is money coming from an LLC, because that might be the reason why. I've seen that before.
Okay. Yeah, I really appreciate it. Thank you. It's been I'm afraid I'm never going to be able to open at this point.
Yeah, I mean, at the end of the day, you might have to start all over and just do it as an LLC.
So dissolve it.
Get a new tax ID. And
So
everything.
I think that's what I'm going to do. I think I'm going to dissolve it, write the letter in, and then do it as an LLC. But I am curious, because I don't really know the full fundamentals and the whole process of it. But isn't it more of a financial add-in to do it as an LLC? Like, in other words, you need more upfront money in order to do it. Right?
Yeah, I mean, there is an expense. There's an expense to filing an LLC. But shoot me an email and I'll break down the cost for you and you'll see it's not
Okay.
like, it's not thousands of dollars, like to be perfectly
It's
honest.
not? See, I assumed it was.
Whoever tells you that is lying to you. They're lying.
Yeah, I definitely assumed it was. I didn't know that. So then maybe that's a better bet. Cause I'm like even going into the city tomorrow for the parade to actually sell stuff. You know,
Yeah.
cause I custom make anything. I
Yeah,
have,
email me, we'll talk.
okay. All right. Sounds good. Thank you. I appreciate it. All right. Thank you.
No. Good. Thank you very much for coming, and
Yes.
feel free to reach out to us if you need additional assistance. We appreciate you attending today. Thank you very much. Can you leave that on? See?